Hello guys, welcome to my channel. Today I am going to be explaining a concept which is used a lot when talking about investments, and some of you might not know exactly what it means, and maybe some of you do know what it means, but you get a bit confused about which companies you should buy, high P's, low P's. Maybe you think low P's are good because you make your money before, or what all this is all about. So I am going to start explaining what PE actually is. So PE is an abbreviation for price to earnings ratio. Okay, so it's the price of the share right now. Okay, slash divided by the earnings of the past. It might be the past year. Okay, might be the past quarter multiplied by 4. Whatever the method is used, normally people use the trailing 12 months of earnings, so that is what is generally accepted. Okay, and yes, I have prepared an illustration here to explain. So logically, if on the top you get the price and on the bottom you get the earnings, you should want a very low price. Okay, so making the PE ratio lower, and high earnings, which will make the PE ratio lower. So why would anyone want to buy a company that has a high price to earnings ratio? Let's check. Okay, so as you can see here in this Excel sheet I prepared, I have two companies here, which it's not they're not two companies specifically. Okay, it is just to illustrate a concept. Okay, so we get company A, which right now costs $100. Okay, a share costs $100, and right now is making $10 a share. So if we take the price and we divide it by the dollars it earns every year, we get to a price to earnings ratio of 10, and we paid 10 times for those earnings. And then for company B, we get that the price is $10. Okay, but it's only making $5 a year. So we would have to be theoretically waiting 20 years to get our money back, just with earnings. Okay, this is not how it actually works, but for you to get an idea. And yeah, you will have paid 20 times earnings in year 1 because there has been still no growth. Okay, so I have supposed that company A, which is trading at a 10 times price to earnings ratio, is growing at a 2% every year. So I am going to suppose that the earnings per share grow 2% every year, and also the price follows the earnings growth. So then the price to earnings stays 10 during the whole study that we're going to be doing here. And for the company B, I have supposed an earnings growth of about 10%. Okay, so quite a good company, that is trading at a 20 times earnings multiple. Okay, because if you get $100 and you divide it by $5, you get 20. Okay, which is the ratio that we are looking at, price to earnings. Okay, so in year 2, net income would have grown for company A 2%, putting it at $10.20, and company B at another 10%, putting it at $5.50. Okay, this is compound annual growth rate. So then you get the past year and then you multiply it by the growth rate. 1 plus the growth rate. Okay, so yeah, that's how it's done. And as we can see, if we paid $100 for buying the share, and in year 2 it's making $5.50, on year 2 we are earning 18. We would only have to wait 18 years. Okay, to get back our initial investment. Okay, and in company 2 we would have 9.8 times we would have paid for the earnings on year 2. If we go to, let's say, year 10, okay, we would be making on company A around $12, okay, more or less. And in company B also more or less $12, okay. So as we can see, if the price to earnings stays how it is, the company B would now be worth around $235, and company A would be worth $120 if it stays at the 10 times price to earnings multiple. Okay, this is how we're supposing this model. And yeah, well, by year 15, as you can see, company B would be making company A would be making $13 and company B would be making $19. So what has happened here? Well, one company, even if we paid more for it, it's growing at a faster rate, so we are making our money, we are making more money in each share, because the company is growing its earnings. Even if the other company is growing at a 2% rate and we paid only 10 times earnings for it, it's still at year 15 earning less money than the company we paid 20 times earnings for. Okay, so this is the illustration I wanted to show you, and why low PE doesn't always mean good, and it can affect your total returns. So this is, I have graphed this here. These are the what you have paid for the earnings. Okay, on year 1 you would have paid 20 euros for company B, and for company A 10 times earnings. Okay, so as you can see, company A is cheaper for the first 10 years on a price to earnings ratio. Okay, but then when you start getting past year 10, you're making more money. Each share you have is making more money on the company which is at a higher growth. Okay, and yes, this is the inverse graph, which is the earnings per share. Starts at 10, company A, and company B starts at 5, and company A finishes at 13 and company B finishes at around 19. Okay, so yeah, this is what I wanted to show you and explain the concept of price to earnings, and why low price to earnings doesn't always mean good. Okay, so you have to be very careful and check how much your company is growing, how consistent the growth is, how much money they are making. These are all really important metrics, and don't only look at price to earnings, but it is a useful tool to see how expensive or how cheap the company is right now, and how many times the earnings you're paying for it, which can help you make an investment decision. This is going to be all for today. I just wanted to help explain a concept which is quite basic, but maybe some of you don't understand. You get fooled by low price to earnings ratios, and that is not always good. So yeah, this is not financial advice. I am just showing what my opinions, and it shouldn't be considered as financial advice. Hope you enjoyed it. I'll see you in the next one. Bye.